Imagine if every dollar you invested had the power to shake the world. What if, instead of funding pollution, exploitation, or unethical business practices, your money could drive progress, sustainability, and social change? For years, investing was all about one thing: profits. But today, more and more investors are asking a bigger question. Can money be a force for good? Socially responsible investing, or SRI, is reshaping the way people think about wealth. It allows investors to grow their portfolios while supporting companies that prioritize ethical business practices, sustainability, and positive social impact. But is it just an idealistic trend, or is it a smart financial strategy? In this video, we will explore what socially responsible investing is, how it works, and whether it is the right strategy for you. What is socially responsible investing? Socially responsible investing is an investment strategy that seeks to generate financial returns while promoting positive social and environmental change. Instead of simply investing in companies based on profitability, SRRI evaluates businesses based on ethical factors such as environmental sustainability, labor practices, corporate governance, and social impact. SRRI investors look at three key areas when choosing where to put their money. Environmental factors include how a company impacts the planet. This can involve investments in renewable energy, waste reduction, and efforts to reduce carbon emissions. Social responsibility examines how a company treats its employees, customers, and communities. This includes fair wages, diversity and inclusion policies, and ethical labor practices. Corporate governance focuses on how well a company is managed. Ethical governance includes transparent leadership, strong financial oversight, and business practices that protect shareholder interests. How does socially responsible investing work? Socially responsible investing follows a process of screening companies based on their ethical impact. There are two main types of screening. Negative screening involves excluding companies that engage in harmful activities. These could include industries like tobacco, gambling, fossil fuels, or weapons manufacturing. Investors who use negative screening aim to avoid businesses that conflict with their values. Positive screening, on the other hand, actively seeks out companies that are leading in areas such as renewable energy, sustainability, fair labor practices, and corporate transparency. Investors who use positive screening look for businesses that align with their values and contribute to social progress. Many socially responsible investors also rely on ESG ratings, which measure a company's performance in environmental, social, and governance factors. These ratings help investors determine whether a company aligns with ethical standards. In addition, socially responsible investment funds, such as mutual funds and exchange-traded funds, make it easier for investors to put their money into companies that meet specific ethical criteria. These funds allow for diversification while maintaining a focus on social and environmental impact. Is socially responsible investing profitable? One of the biggest concerns investors have about socially responsible investing is whether it can generate competitive returns. Many assume that prioritizing ethics means sacrificing profits, but research suggests otherwise. In fact, socially responsible investing is increasingly seen as a strategy that balances financial growth with long-term sustainability. Studies have shown that companies with strong environmental, social, and governance practices often outperform their competitors over the long term. Businesses that prioritize sustainability and ethical operations tend to be more resilient during economic downturns, attract loyal customers, and avoid costly legal or regulatory issues that can negatively impact their bottom line. Additionally, companies with strong ESG practices often have better risk management strategies, which can lead to more stable and consistent returns for investors. In recent years, socially responsible investment funds have delivered returns that are comparable to, and sometimes even better than, traditional investment options. As more investors recognize the financial potential of ethical companies, demand for these investments continues to grow. How to get started with socially responsible investing? If you want to align your investments with your values, there are several steps you can take to get started. Socially responsible investing is not just about choosing ethical companies. It is about creating a portfolio that reflects both your financial goals and your commitment to positive change. First, define your personal values. What causes or industries matter most to you? Do you want to support renewable energy, sustainable agriculture, or businesses with strong diversity and inclusion policies? Are fair labor practices, human rights, or environmental sustainability important to you? Understanding your priorities will help you filter out investments that do not align with your ethical standards and focus on companies that share your vision. Next, research companies and funds that align with your values. Look for businesses with strong ESG ratings, which measure a company's environmental, social, and governance performance. Many financial institutions provide ESG scores to help investors evaluate companies based on sustainability and ethical business practices. You can also consider investing in socially responsible mutual funds or exchange-traded funds, which bundle multiple ethical investments together, providing diversification while maintaining a focus on values-based investing. Another strategy is shareholder advocacy. Some investors choose to buy shares in companies and use their influence as shareholders to push for ethical changes within those businesses. This can include voting on corporate policies, attending shareholder meetings, and joining investor coalitions that advocate for sustainability and responsible corporate governance. By taking an active role, investors can drive meaningful changes from within. Finally, consult with a financial advisor who specializes in socially responsible investing. They can help you develop a strategy that aligns with both your financial goals and ethical values, ensuring that your investments are both profitable and impactful. A professional advisor can also help you navigate complex ESG ratings, identify high-performing SRRI funds, and tailor a diversified investment plan that meets your long-term financial objectives. By following these steps, you can make informed investment decisions that not only grow your wealth, but also contribute to a more sustainable and ethical future. Should you invest in socially responsible funds? Socially responsible investing is not just about feeling good. It is about making smart, strategic financial decisions while supporting companies that are driving positive change. It allows you to grow your wealth while ensuring that your money does not fund industries or practices that conflict with your values. It also provides an opportunity to invest in the future, supporting businesses that are actively working towards sustainability and ethical governance. However, like any investment strategy, it requires research and careful planning. It is important to evaluate the performance and risk levels of any investment before making a decision. Conclusion: the way we invest has the power to shape the future. Every dollar you put into the market sends a message about the kind of world you want to live in. Socially responsible investing is about more than just profits. It is about using your financial power to create change. It is about proving that doing the right thing can also be the smart thing. If you are ready to start investing in a way that aligns with your values, research your options, explore SRRI funds, and take the first step toward making a difference with your money. Do you think socially responsible investing is the future of finance? Let us know in the comments, and do not forget to like, share, and subscribe for more insights on smart investing strategies.